Good evening. Tonight, we are tracking a convergence of significant developments across global commodity markets, credit systems, and currency reserves that analysts say merit close attention. From physical gold shortages in China to historically low speculative positioning in silver, and from mounting stress signals in private credit markets to a record low in United States housing activity, the data points emerging this week are painting a complex and interconnected picture of the current financial landscape. We begin with gold. The precious metal is currently trading at $5,098 on the Western spot market. The figure is notable on its own, but the circumstances surrounding it add considerable weight. China returned from its Lunar New Year holiday this week, and reports from the ground level indicate that multiple gold retail shops across the country have halted bar sales entirely. More significantly, contracts that were signed and agreed upon prior to the holiday period are now being refunded outright. Not delayed, not rescheduled, but canceled and returned. That distinction matters. When a seller chooses to refund a customer rather than source and deliver the physical product, it is a direct indication that the metal itself cannot be obtained at current conditions. What makes this development particularly noteworthy is the timing. Gold reached its current price level during a period when China, widely regarded as the world's largest gold-consuming nation, was effectively offline for the duration of the holiday week. Conventional market logic suggested that the temporary absence of Chinese demand would create downward pressure on prices. Instead, gold held its position and continued moving higher, absorbing multiple headwinds simultaneously, including a Supreme Court tariff ruling, broader policy uncertainty, and a period of dollar strength without retreating. Now, with China back in the market and reportedly unable to source physical metal for retail delivery, the conditions that drove prices to current levels appear to be intensifying rather than easing. Turning now to silver, where a separate but equally significant set of conditions is coming into focus. Silver moved 16% higher off its weekly lows, a substantial move by any measure. However, what makes that price action particularly striking is the positioning data behind it. Managed money long positions in the COMEX silver contract. The speculative funds that typically chase market momentum and amplify directional moves are currently sitting at their lowest level in 20 years. To place that in historical context, current speculative long positioning in silver is below even the levels recorded during the depths of the 2008 global financial crisis. In other words, the recent 16% move occurred without meaningful participation from the speculative trading community that would ordinarily be expected to drive a move of that magnitude. On the currency side, the United States dollar's share of global foreign exchange reserves has now fallen to its lowest point in 32 years, currently standing at 56.9%. That figure represents a significant decline from a peak of 72% recorded at an earlier period. The reduction in dollar reserve holdings among central banks is not attributed to a single event, but rather to a combination of factors, including concerns over United States debt trajectories, persistent fiscal deficits, and what observers describe as long-term credibility, erosion in the dollar's role as the dominant global reserve currency. Central bank and investor demand for gold has averaged approximately 610 tons per quarter over the most recent 2 quarters on record. That figure sits 230 tons above the thresholds that has historically been associated with approximately 3% quarterly price appreciation in the metal. The demand level being sustained at present is therefore running materially above the historical benchmark that has previously driven meaningful price increases. Taken together, the silver positioning data, the dollar reserve shift, and the central bank demand figures form what analysts describe as a structural supply and demand imbalance. The supply side of the equation is also under pressure. The physical delivery failure now being reported in China as gold retail market following the Lunar New Year. Reopening is being cited as a real-time expression of a supply structure that is unable to meet current demand levels. These are not projections or forecasted conditions. They are documented figures, reflecting activity that has already occurred within the current market cycle. We turn now to the credit markets, where a separate set of data points is drawing attention from financial observers. There is currently a $2 trillion private credit market that has been functioning as a primary funding source for artificial intelligence infrastructure development, including data centers and large-scale computing capacity. One of the significant participants in that lending system manages approximately $273 billion in assets. That institution has recently moved to restrict withdrawals from a $14 billion retail fund. When a fund of that scale restricts investor withdrawals, it immediately raises questions in the broader market about whether sufficient liquidity exists within the fund to meet its obligations to investors. The companies that have been borrowing within this private credit system carry substantial debt loads, accumulated in order to build out infrastructure that may not generate cash returns for a number of years. The concern being noted in the data is that if artificial intelligence revenue growth does not materialize on the timelines or at the magnitudes that were projected, financial stress would not remain confined to technology sector equities. It would migrate into the credit structures themselves. And private credit, at $2 trillion in deployed capital, represents a significant concentration of pension and insurance funds placed into illiquid financial structures. That is not a niche corner of the financial system. It is a substantial portion of institutional capital, operating under conditions that limit the speed at which that capital can be recovered or repositioned. Simultaneously, the United States housing market is registering its own stress signal. The pending home sales index has printed at an all-time low, reflecting a decline of more than 43% from its peak level. Contract closings fell more than 8% within a single month. The combination of a frozen housing market and early liquidity stress signals emerging from private credit is occurring at the same moment that gold volatility has reached its highest level since the global financial crisis. Volatility at that level in a commodity market is interpreted by analysts as the market, pricing in tail risks, low probability but high impact events that have not yet fully materialized but are visible within the available data. It is also being noted that gold has outperformed the S&P 500 across every major time frame measured, including 1 year, 5 years, 10 years, and 25 years. Silver miners, meanwhile, are currently sitting only 14% below their all-time highs, while spot silver itself remains 44% below its own nominal peak. That divergence between equity market pricing and spot commodity pricing is a condition that intermarket analysts track closely. Additionally, silver has now recorded 10 consecutive green monthly candles, which is reported to be an all-time record for the metal. As we bring together the data points covered throughout this report, what emerges is a series of developments across multiple asset classes and financial systems that are occurring simultaneously and, according to the figures available, appear to be interconnected rather than isolated. Tonight we examined conditions spanning physical commodity markets, global currency reserves, institutional credit structures, and domestic housing activity. Each data set, viewed individually, carries its own significance. Viewed collectively, they form a broader picture of conditions that financial observers say warrant careful attention. To summarize the key figures reported this evening, gold is currently trading at $5,098 on the Western spot market. Physical delivery failures in China's gold retail sector are being expressed through outright contract refunds following the country's return from the Lunar New Year holiday. China is widely regarded as the world's largest gold-consuming nation, and the inability of retail sellers to source physical metal for delivery is being documented in real time. Gold reached its current price level during the period when China was entirely absent from the market, absorbing a Supreme Court tariff ruling, policy uncertainty, and a dollar relief period without retreating. In silver, managed money long positions on the COMEX contract are at a 20-year low, sitting below levels recorded even during the 2008 global financial crisis, despite the metal posting a 16% move off its weekly lows. The United States dollar's share of global reserves stands at 56.9%, its lowest level in 32 years, down from a peak of 72%. Central bank and investor demand for gold has averaged 610 tons per quarter over the most recent 2 quarters, which is 230 tons above the historical threshold associated with approximately 3% quarterly price appreciation. In private credit markets, a fund manager overseeing approximately $273 billion in assets has restricted withdrawals from a $14 billion retail fund. The $2 trillion private credit market, which has been a primary funding source for artificial intelligence infrastructure, is showing early liquidity stress signals. At the same time, the United States pending home sales index has recorded an all-time low, down more than 43% from its peak, with contract closings falling more than 8% in a single month. Gold market volatility has simultaneously reached its highest level since the global financial crisis, a condition analysts associate with markets pricing tail risks that are visible in the data but have not yet fully materialized. Silver has recorded 10 consecutive green monthly candles, reported as an all-time record. Silver miners are 14% from their all-time highs, while spot silver remains 44% below its nominal peak. And gold has outperformed the S&P 500 across every major measured time frame, including 1 year, 5 years, 10 years, and 25 years. These are the documented figures and reported conditions as they stand at the time of this broadcast. As always, this report reflects the data and events as reported and does not constitute financial advice of any kind. All investment decisions remain the sole responsibility of the individual. We will continue to monitor these developments and bring you updates as new data becomes available. For this evening, that is our full report. Thank you for watching, and we will see you next time.